As an industry, hedge funds did not outperform the stock market last year, but there are exceptions. At the GAIM Hedge Fund Conference here in Florida, Chris Hentemann's fund was up better than 34% last year. He joins me now. Good to see you, Chris.
Thanks for having me.
Now, your specialty is structured credit. I'm curious, you started the firm a couple years ago just as housing really was starting to collapse. Was that why you started the firm? I mean, did you see opportunities then?
Yeah, absolutely. I mean, it was a career progression for myself and my team. I mean, we've been in this sector for over 20 years, which has given us exposure to multiple cycles. And what we were seeing in the housing market years ago was basically a deterioration in credit, an over leverage in terms of the structure, and then we started to see the repricing of that in the markets in 2007 and 2008, and just felt it was going to be a once in a lifetime career opportunity to get in as an aggressive, opportunistic investor. And so, and there was nothing better than putting your own money into it, and so which gave us the motivation to start the company in 2008, and then execute the portfolio strategy for the past couple of years. And
So where are we now in terms of what is attractive to you? Are you still looking at residential credit? Are you looking more at commercial credit? Where is the opportunity? Has that part played out for you?
The residential part of it is still actually extremely attractive. It has been our focus for the last about 2 years, and the momentum is still there. It's transitioning. It was originally basically a play on the premiums, the excessive premiums that were built into the sector on the backside of the dislocation, which was really the story in 2010, 2011, and early 2012. What we started to see midway through 2012, which is what gets me excited about it in 2013, 14, and beyond, is we're now seeing the objective evidence of a fundamental recovery. You're starting to see that objectively default rates are starting to decline. You're starting to see that after the Attorney General settlement, the servicing industry is starting to clean up a lot of the distressed loans on in the servicing sector, and so the traffic is moderating. And then probably most importantly, and where there's a lot of significant upside, is you're starting to see housing prices recover, which means that the distressed sales that are moving through the market will actually have improved recoveries. So all of that actually combines and manifests itself in basically the expected returns that we think will continue to grow into the next couple of years.
Tell me a little bit more about the portfolio in terms of the type of debt that you are holding right now.
Okay, so one of the things that actually we did focus on, and I think separated ourselves very clearly from our peer group, was we focused on securities, particularly that were seasoned. So securities that were originated in 2003, backed by loans that were originated in 2003, 2004, and 2005. These are loans where actually the underwriting criteria was much better. The securitization market were much more fundamentally balanced in terms of their structural leverage. We felt that those were the securities that were actually thrown out. The baby was thrown out with the bathwater and would actually have the earliest recovery. And so those were the securities that we biased over the past 12 to 18 months. Behind that, we're starting to see the fundamentals also improve the return characteristics of some of the worst underwritten loans of 06 and 07, and those are the opportunities that are evolving today.
What's the biggest risk for you when you look out this year with your portfolio?
Clearly, it's a long biased credit strategy, and that has a sensitivity to macro volatility. So anytime you get a significant spike in volatility, you're going to get basically a widening in credit spreads. So like 2011, we had a significant rise in volatility, obviously due to the European crisis, due to the deficit debates, and that increased volatility, and it put pressure on credit spreads. And I think we managed actually very well through that. We had a positive return in 2011, so we were able to adapt, primarily because we were focused on that being one element of basically the risk equation that we have to manage to. The second is clearly fundamentals. It is basically, for the way we're positioned, it does have a bias towards a recovery, but it's not dependent on a recovery. So if you get a significant downturn, it will impact the returns, but basically we have a portfolio that's set up to mitigate that, primarily through the generation of cash flow-based returns. So the portfolio has a natural deleveraging profile to it.
What do you think of the commercial real estate market overall? You know, there was a lot of worry about that market that never really materialized, and there's been so much focus on residential. I'm just curious what you think is happening in that space, not even on the credit side, but just more broadly.
Yeah, we like it. I mean, it's a space that is evolving fundamentally right behind the residential mortgage story. It's a more concentrated sector in terms of its credit risks. The underlying loans are larger. They're more complicated in their structure. So the distress that was embedded in it, just like the distress of the mortgage market, does take some time for itself to evolve. And we feel that basically it's turning a corner fundamentally, like residential did about a year ago. We're starting to see basically vacancy rates are starting to peak and starting to come down nationwide. We're starting to see basically delinquency rates are starting to recover. We just went through a year of significant loan maturities that the market actually handled fairly well. I mean, there was a lot of basically anxiety around whether these 5-year balloon maturities were actually going to put more stress on the sector, and the market managed it very well in 2012, and we think set it up for basically a good recovery in 2013 and beyond. It's an increasing exposure in our portfolio today.
All right, Chris Hentemann, 400 Capital Management. Good to see you.
You too, thanks.
I'm Rhonda Schaffler. This is Reuters.